What is happening?
There's a new round of tech layoffs. Amazon will lay off 18,000 workers.
The FDIC just reported that California regulators shut down Silicon Valley Bank.
A year ago, the national price for a gallon of milk was $3.49. Now it's around $4.20.
We're barely halfway into the year, and this is what we're dealing with. As inflationary pressures keep pushing up prices for ordinary folks, policymakers and economists keep debating whether the country is currently experiencing a recession. This debate is complicated by the fact that current economic indicators contradict one another and follow different patterns than previous recessions, making a clear judgment difficult to reach. The uncertainty is causing widespread anxiety, as evidenced by the number of searches on Google for phrases like, "When is the next recession? Are we in a recession? Is a recession coming? And how long will a recession last?" However, amidst all these uncertainties and challenges, I want you to take a step back and open your eyes and see what is potentially the biggest market opportunity in history. You see, folks, for an average Joe, a recession means a time to panic. Worries about job security start creeping in. They start having sleepless nights wondering if their retirement savings will hold up. And fears about rent skyrocketing and the prospects of ending up homeless worry a lot of folks to death. Now, all these reasons are valid things to be worried about, but while you're wrestling with these anxieties, you have to understand that you're losing sight of one of the biggest opportunities in your life. The big questions you should really be asking are, how can I profit from a recession? Or, if you're really savvy, how can I make a fortune from a recession? However, if your only interest is to weather the storm, then you should be asking, how should I financially prepare for a recession? I understand when you hear the word recession, images of financial woes, job loss, or even homelessness come to mind. But I want you to stop thinking like 99% of people and start thinking like 1% of the population, who, when they hear that word recession, their minds start salivating like a teenage kid staring at an ice cream cone on a hot Sunday afternoon, who sees this time as an opportunity of a lifetime to make, one like no other, to make a Mount Everest-sized fortune. That's how I want you to think and see. When everyone and their mother, when the newspapers and TV channels are all dancing to the same tune of the world burning down, the stock market crashing, unemployment going up, businesses closing down, you know better. Like a lion in the Serengeti, you see the gazelle approaching, and in the right moment, you'll strike. So, if you're still wondering, is it even possible for me to make money during a recession? The answer is yes. Otherwise, businessmen like Warren Buffett, Paul John, Ben Bernanke, Jamie Dimon, and Carl Icahn wouldn't have made big bucks during the 2007 to 2008 financial crisis, which, by the way, was one of the worst since the stock market crash of 1929. Of course, you have every reason to be skeptical about your ability to make money during a recession. After all, economic downturns are often difficult times for many people. But this does not have to be your reality. On the contrary, if you play your cards right, the looming recession could be your ticket to immense wealth. To help you out, in this video, I'll dish out a few tips on how you can beat a recession and profit from it. But before we talk about these opportunities, you first need to understand what you're going to be up against. To start, we need to talk about what a recession is. So, what is a recession? How do we know when the economy is actually in one? And who decides when it starts and ends? In economics, a recession is when a country's economy stops growing and begins to shrink. When the economy contracts for at least 2 consecutive quarters, that is, 6 months or more, it is officially considered a recession. In the US, for example, the National Bureau of Economic Research, NBER, which consists of a group of economists, is in charge of all decisions concerning recessions. And according to its Business Cycle Dating Committee, for a country to be in a recession, there must be a significant decline in economic activity that affects the entire economy and lasts for more than a few months. To determine a recession, the National Bureau of Economic Research considers several economic indicators whose outcomes are highly correlated with the GDP. Examples of these indicators include personal income, employment rate, consumption levels, wholesale retail sales, and manufacturing output. When these indicators show negative trends, such as a drop in income levels, low consumer spending, a rise in the unemployment rate, and a decline in values across everything from stocks, food, and energy to different services, these are warning signs that an economic recession might be approaching. Let's take a deeper dive into these indicators. A spike in unemployment often suggests that businesses are not creating enough job opportunities, which implies that economic growth is slowing. Every quarter, companies report their revenue and share future projections of their financial outlook. But lately, they've been lowering their predictions as they anticipate slower growth or a decline. In fact, we're not even halfway through the year, but several companies in the housing and tech industry have already laid off hundreds of workers.
Why are so many jobs being lost in the sector worldwide? And is big tech in big trouble?
A quick Google search will show you dozens of companies laying off their staff. Some of these companies include Google, whose layoffs impacted about 12,000 employees worldwide, Walmart, Amazon, LinkedIn, Meta, and Dropbox. The list is quite frighteningly huge, and I can't exhaust them all in this video. Unemployment is another indicator, and it's one of the most telling signs of a recession, because like a domino effect, it sets off a chain reaction. This means it affects other economic factors directly linked to a downturn, like a drop in wages, low consumer spending, and low wholesale retail sales. In this comparison, look at unemployment as the first domino that falls, knocking down all the other sectors. For instance, if you lose your job or start working fewer hours, you'll have less money coming in. This may affect how you spend your income or savings. You may not be able to afford the little luxuries you're used to enjoying. This could be due to higher prices. Or you may be afraid of spending your money because you're unsure of your long-term financial situation. Until you find a job that provides a stable income, you may have to forego non-essential items and prioritize necessities like housing, utilities, and transportation costs. The other economic indicator is a slowdown in consumer spending. When people are hesitant to spend, most businesses that don't offer essential products or services will suffer due to the less demand and consumption of their items. As a result, they may have to reduce the number of products they make, cut prices to attract more sales, or even lay off some workers to reduce their production expenses. Furthermore, when people buy less, retail sales drop. As a result, retailers may have to order fewer items to sell, and most investors will be discouraged from making new investments. And you know what happens next? The whole production industry takes a hit, and manufacturing activity decreases, leading to a decline in economic growth. This, in turn, affects the government as the tax base decreases, since people and businesses are paying less taxes. This is what happens. The National Bureau of Economic Research Committee identifies the highest point of the economy, using the economic indicators we discussed earlier. They pay special attention to the employment rate and a measure of income that accounts for inflation, excluding government support payments like Social Security. Once the peak has been determined, a recession is expected to hit. To establish the end date, on the other hand, the committee determines the lowest point of the economy, which usually happens a few months after the actual low point. That lowest point is considered the end of the recession. However, most of the time, it takes a while, and sometimes even up to a year, for the National Bureau of Economic Research to publicly declare a recession that has already begun. Now that we've established what a recession is, let's discuss how you can use this information to create wealth. Number 1, invest in stocks. Investing in stocks is one of the easiest options because it requires minimal time and effort to get started, and the possible return is very high. If you're earning an average salary and regularly invest 10% of it each month in the right way, your money will grow. The sad thing about investing is that most people don't even get started because they believe the stock market is only for the wealthy and too complex for regular folks. Unfortunately, most of those who gather the courage to start investing do so only when things are going well. When the market experiences a downturn, they lose interest, or even worse, sell all of their stocks immediately. This leaves them trying to time the market for the ideal re-entry point, which might not happen immediately. When the economy is struggling, it's easy to lose faith in the stock market and give up on stocks altogether. But most experts strongly advise against this. Even during a recession, specific sectors continue to thrive and provide investors with steady returns. Therefore, instead of selling your stocks, like what 99% of folks will do, you should be the 1% who buy as much as possible. You may be thinking, why would I invest more when stocks are falling faster than a sinking ship? The economy is dying and banks are failing. I get it. I totally understand where you're coming from. Investing your hard-earned cash every month and then watching the prices go down can bring even the toughest man to his knees and tears. It's painful and discouraging. But here's the thing. Investing is all about long-term strategy. Look at this chart of the S&P 500. It's a basket of the 500 largest publicly traded companies on the US stock exchange. Now, thanks to the 2008 financial crisis, in 2009, its stock fell to its lowest point ever since 1996. Basically, the financial crisis of 2008 wiped out all the gains it had made since 1996. Now, this kind of news sends shockwaves all over the world, and it's the kind of news that sends 99% of folks to start panicking and selling. But remember what I told you in the beginning. You have to see this as an opportunity. Look at the same graph. 2 years later, the stock doubled. That's a 100% return on investment, assuming you got it at its lowest point in 2009. Now, 3 years later, it was back to where it was since the 2008 financial disaster. This is a testament to the fact that the stock market always bounces back. And here's more great news. If you kept holding on, you would see your money and fortune continue to grow over the years. The S&P 500 is just one example of the many stocks that have done well since the crash. And there are many more. Just ask the guys in the comments section, who will tell you all the stocks that have grown in leaps and bounds. Some even at 1,000% plus growth. So even if the market might crash, it's crucial to remember that it will eventually bounce back. That's why experts strongly advise against selling your stocks and giving up on your investments. In fact, they believe that when the market takes a nosedive, you should consider investing even more. Why? Because just like you've seen, you'll be in a greater position when the stock market eventually recovers. You can even sell your shares for a profit. So, if you want to invest in equities to protect yourself during a recession, consider investing in industries like healthcare, utilities, and consumer goods, or an index like the S&P 500. Why? Well, people will always spend money on necessities like medical care, household supplies, food, and electricity, regardless of the state of the economy. That's why stocks in these sectors often perform well during tough times. It's worth considering these sectors as a potential shield for your investments during a recession. If you find the stock market too complicated, don't worry. There are other investment opportunities you can explore. One option is to invest through tax-advantaged retirement accounts. These accounts offer tax benefits, but you'll need to wait until you reach the age of 59 and a half to withdraw money without facing penalties. The most popular retirement account options include 401ks, traditional IRAs, and Roth IRAs. Another option is to open an individual brokerage account with one of the top stockbrokers. With this type of account, you won't face early withdrawal penalties. Still, you won't receive the same tax savings as retirement accounts. When it comes to deciding what to invest in, many people choose investment funds to keep things simple. Index funds that track the S&P 500 are a popular choice, as they provide exposure to the 500 largest publicly traded companies on US stock exchanges. The second option is to buy into dividends. For those unfamiliar with financial terms, let me explain what dividends are. Think of a dividend as a special treat given to shareholders as a way to reward them for buying shares of a company. This treat usually comes from the company's net profits, which means whenever the business earns a profit or has surplus cash, a portion of it is set aside for the shareholders to share. If you own shares in a company, you'll be entitled to a slice of the profit when the company does well financially. It's like a little bonus for being part of the company's success. So, if you want to invest in dividend stocks during a recessionary period, the best ones to focus on are those from large, well-established companies with solid financial foundations. These companies are better equipped to withstand economic downturns than smaller companies that struggle financially. In addition, these companies are more likely to pay dividends to their investors. Dividends serve multiple purposes for investors. Firstly, if a company has a long track record of paying and increasing dividends, this will give you the confidence that the company you've invested in is financially stable and capable of withstanding various economic conditions. Secondly, dividend investing provides a steady stream of income and the potential for compounded returns. Even if share prices decline, you'll still receive returns on your investment. So why dividends? Well, if we look back over the past century, dividends have made up nearly 40% of the entire profit of the S&P 500. That's a significant amount. Not only that, but stocks that pay dividends tend to perform better than those that don't. This signals to us that dividends-paying stocks are a reliable indicator of strong performance in the stock market. If you look at the list compiled by Forbes Advisor, it's a helpful resource which highlights the top 10 dividend-paying companies in the U.S. stock market. These companies have continuously increased their dividend payouts for at least a decade. In addition, they offer attractive yields and have demonstrated strong earnings growth over time. Investing in these companies can provide you with a sense of stability and the potential for long-term gains. So whether you're seeking professional advice or conducting your own research, this list can serve as a valuable starting point for identifying promising dividend opportunities. The other investment opportunity to consider is real estate. The appealing potential of real estate investment is undeniable. It not only diversifies your investment portfolio, but it also has the potential to generate a consistent stream of income over time, if done correctly. While the 2008 housing market collapse was a nightmare for many homeowners, it turned out to be a golden opportunity for certain real estate investors. Well, when a recession hits, the value of homes usually plummets, which means you can snatch up properties at much lower prices. And here's the exciting part. If you can find a reliable tenant and rent out the property, you'll have a steady income coming in while you weather the storm of the recession. Then, as the real estate market starts to recover and prices start to rise again, you can sell the property and potentially make a nice profit. The trick is knowing how to use the market's ups and downs to your benefit. Among the many options for real estate investment are: 1. Investing in the old-fashioned way. The traditional approach to real estate investment involves purchasing a property with the intention of either renting it out to tenants and earning rental income, or selling it later at a higher price to make a profit. You can do this once or multiple times, depending on your financial capacity. You could even aim to become a real estate mogul by consistently flipping houses for a profit. Or you could just rent out your vacation home when you're not using it. When calculating affordability, remember to factor in maintenance expenses, periods of vacancy between tenants, and property taxes. These expenses are crucial and should not be overlooked while making investment decisions. If you don't want to become a full-time homeowner, you can invest in real estate through REITs. When you buy shares in an REIT or an REIT fund, you can earn profits from the dividends that real estate companies pay out to their investors. So, with REITs, you have a couple of options. You can either invest directly in a specific REIT or opt for an REIT mutual fund by buying shares in a fund that invests in various properties. Also, these mutual funds can be actively managed by professionals who make the investment decisions on your behalf. Or they can be passively managed REIT index funds that track the performance of a particular index. It's important to note that REITs can focus on domestic real estate, or even include international properties in their portfolios. This way you can have exposure and tap into the real estate market without having to deal with the day-to-day operations of the managing properties. The other way to invest in properties is through real estate crowdfunding. Crowdfunding has come to real estate, and today, several startup companies now allow individual investors like you and I to make small, medium, or significant investments in real estate projects, and then get returns that are proportional to how much you put in. Now, with crowdfunding, you have to make sure that you've done your homework and you're investing with a trustworthy company and understand the tax implications. You should also understand that since you're choosing individual properties, you won't have the same level of diversification as you would with other investment options. So before you get into real estate investing, you should consider the tax implications associated with the industry. Knowing the taxes that you'll have to pay will help you assess your expenses and potential earnings more accurately. One crucial aspect is to find out how your property is classified, because that will determine the precise taxes that you'll be responsible for. The two most popular types of real estate taxes are short-term capital gains and long-term capital gains taxes. Both taxes apply to the income you earn from selling a property. If you sell your property less than a year after you bought it, you have to pay the short-term capital gains tax. On the other hand, the long-term capital gains tax applies to property owners who sell their investments after holding them for at least a year. So, if you want to know the exact amount you'll pay in taxes, you should study and be conversant with the federal income tax brackets. These brackets will provide you with the information you need to understand the specific tax rates based on your income level. Generally, investing in real estate is a smart move if you want to increase your chances of earning good returns. It's a great way to diversify your investment portfolio because it often performs differently from stocks and bonds. Though real estate investing has the potential to build long-term wealth, it also comes with some uncertainties. You may encounter several challenges along the way, so it's crucial for you to be prepared for that. If you're unsure whether real estate investments are suitable for your portfolio or need help managing your existing investments during market fluctuations, it's a good idea to seek guidance from a financial advisor who can provide valuable insights and support to ensure you make informed decisions and navigate the real estate market effectively. If you want to make long-term investments, the prospect of an impending recession shouldn't scare you. Recessions can indeed be unpredictable and can have a profound effect on your life. But some strategies can help you position yourself and your investments, and these include investing in the stock market, investing through tax-advantaged retirement accounts, buying into dividends, investing in consumer goods, medical supplies, utilities, and energy, and lastly, investing in real estate. And always remember to seek professional help where need be. So, let's circle back to the question that continues to occupy our thoughts. Is the US economy currently experiencing a recession or not? Statistics show that most people are still employed despite the recent wave of high-profile layoff announcements by some big corporations. According to a report by the Bureau of Labor Statistics, the number of people applying for unemployment benefits has dropped to a 9-month low of $186,000. The unemployment rate is also relatively low, at 3.5%, the lowest it's been in half a century. In addition, there are around 10.5 million job openings available, giving people opportunities to find work. At the moment, most economists agree that the US isn't going through a recession.
Is currently at least nowhere close to recession.
The most recent GDP report published not too long ago shows that the US economy increased by 2.9% in the last quarter of 2022. Before that, it had grown by 3.2% in the previous quarter. These numbers are higher than what's needed to meet one definition of a recession, which requires 2 consecutive quarters of negative growth. This information suggests that the current state of the American economy is promising. However, the same economists also predict that a mild recession could be hitting soon.
Yes, we do expect that there will be a recession. It's probably starting right about now. All of our indicators suggest that.
They believe that this time, the recession might be different from the ones we've seen before in the US. So, until the National Bureau of Economic Research officially declares a recession, it's important to take care of your finances. Try to minimize the amount of debt you have, save up some money for emergencies, and be prepared to take any job if you lose yours. It might be tough, but remember that recessions eventually come to an end. Well, that brings us to the end of the video. Thank you for watching and staying with me till the end. If you have any comments or thoughts you'd like to share, please do so in the comments section below. I'm looking forward to hearing from you. If you want to learn how to make wise and smart investments, check out this video.